Hello and welcome to Policy Bazaar. I'm Arjun Bhagat. Now, retirement is an important phase in any individual's life. It is the phase when we sit back and spend quality time with our loved ones, do things that we love to do and enjoy the fruits of years of hard work and sacrifices. Most of us save a sizable corpus from our earnings with an intention to generate income, match inflation and sustain our lifestyle after retirement. But what happens once we have retired? Should it stop you from making further investments? Not if you want to have fun and financial security along the way. Sure, you have your pension benefits to meet your requirements, but would it be able to match inflation and sustain your expenses for the rest of your life? As you won't have access to regular income post-retirement, it is essential for you to diversify your savings and meet your requirements for the rest of your life. Now, today, we'll be discussing about how you can continue investing post-retirement with special emphasis on health insurance. Let's welcome our guest, Yashish Dhaya, CEO and co-founder of Policy Bazaar. Welcome to the show, Yashish. We're talking about retirement investments. Now, why is it important to invest even when one has retired?
See, one believes when we are younger that income is made only by getting a job or a salary or running a business. But we all know money is also made from money. And if you just do a small thing, if you go to banks or if you go to any bank and you check who has the maximum savings, it'll usually be the senior citizens. Most of the banks, the large deposits are sitting with senior citizens. And I think there is a lot to making those deposits work harder, to making that cash that they have earned over years of effort, whether it's come in terms of a PF payout or whatever it is, that corpus that they have got, work harder. There are lots of ways to do that, and it will depend on each individual what their outlook towards the future is, how long do they think they want to have savings for, what their family support system is like, how comfortable they are with their corpus statement. The basic thing is, can they afford to still take risky bets, or do they really need to save? I think that still stays a question mark, because somebody who has a lot of cash, much more than what their day-to-day requirements are, may actually spend a lot of time, doing some strong trading or some strong long-term market investments. However, for a lot of people, that may not be the option. The option for them, for a lot of people, is to just make sure the corpus that they have, make sure it goes the longest possible, make sure it creates the maximum possible. For those individuals, I think there are clear maximization opportunities for senior citizens.
So I guess that's the key.
Yes.
Maximizing your corpus so that it sustains you for even longer or gives you back better returns. But a lot of people would consider that risky. They'll say, I don't want to take a risk. I've retired. I don't have an income. So how would you, comfort them?
My strong view is that people, when they go in to retirement, they actually should take a 1 to 2 day course in financial planning. I genuinely believe so, because that is the point of their life. When
are there such courses available?
Even if they are not, they can be created.
Right.
If there is a demand, so they can be created. And there are genuine.
So basically
advisors.
What you're saying is that they need to go out there with their eyes open and make the best possible financial decisions.
That is the stage when people have the maximum amount of corpus lying with them. I recently got a call from a friend of mine who said, my father-in-law has these policies, has these different investments. Can you have a look at them? We sent somebody from our office to go and kind of have a look at this, just to kind of make this real. This friend is Rajeshwar Bhandari. He works in Fortis. He's the CEO of Fortis in Gurgaon. He asked me to go and look at his father-in-law's plans. They were sadly such bad plans, such bad investments, that we felt pained. We felt very pained. This was a person who had his lifetime corpus spoilt because of wrong advice. It's very important, because we are also susceptible. We are susceptible to anybody's advice. We trust a lot of people. I think one has to be very careful and make sure that you maximize understanding the risk that you're taking on. And there are a lot of options. As we talk through today, there are a lot of options available to them which are very safe.
So let's go over some of those options
Sure.
that are available right now.
Sure. So there is the National Senior Citizens Savings Scheme. This is today giving about 9.3% returns to people above the age of 60, started by the government of India. Nobody's going to come and talk to you about it, because if you buy this from me, I make nothing. If you buy it from somebody else, nobody makes anything. But for you, that's the best option. And you have time. The good thing is, when you're at that age, you have time to explore. So one must spend that time. There is the postal system. There are both monthly income plans and there are term deposits available with the postal system. Most of these are giving you returns between 8.5%, 8.2 to 8.5%. Much higher than any plan which anybody will come and sell to you, whether it's a bank or whether it's an agent or whoever. It's going to be way better. So, and again, I will make nothing out of it. Again, just for anybody who thinks that I'm going to kind of benefit by this advice. But it's good for the individual. I think like that, in case you have extra corpus, then you start thinking about mutual funds. If you have that extra corpus and the comfort, because see, if you're 60, a lot of people, life expectancy is increasing. People are retiring at 60. But a lot of these people will live beyond 18 or 20 years is a very, very long time. And inflation in 20 years, the fixed deposit will get crippled, because the cost of goods will increase faster than the interest rates that the banks can pay you. So clearly, that's not a strategy that's going to work. So eventually, if you do have that corpus, that comfort, where you can take a bit of, it's not called risk. I don't see mutual funds over the long term as risky. I see them over the short term as very risky. But if you have that time frame, then clearly look at those. Clearly look at even things like, unit-linked products, etc. But I think that might not be right for you if you're 60 plus. I think when you're 60, you just go for mutual funds.
So what are the factors, one or two factors or three factors that they need to keep in mind before investing?
I think if you're going for a guaranteed return product, just go for the highest return and be very, very sure of what that return is going to be. And do not believe any one person or two people. Just do your research. You have time. There's no hurry. One doesn't have to do this investment in a day. Take your time, do the research, go for the highest return products. Many of them are actually national schemes, which nobody's going to come and sell to you. You have to go and find out about them on your own. In fact, people will dissuade you from those. So the ones I mentioned, National Savings Scheme, the postal scheme. In the National Savings Scheme, you can go from 1,000 rupees to 15 lakh rupees. In the postal schemes, there is kind of no limitation on how much you can invest. The minimum investment is 100 rupees, 200 rupees a month. You can go invest on a monthly basis, you can invest on a one-time basis. But those are the plans you need to be investing in. Of course, there's the fixed deposit, which is the easiest. Your bank has them. But do not let them take your money out of fixed deposit and put it into various plans, etc. Please keep them in that fixed deposit, because that actually gives you...
A lot of banks push you for that.
Because clearly on the fixed deposit, they would earn a little amount. But if you can put that into a life insurance plan or something, they will earn a little more. What life insurance do you want? You're 60, 65. Your working stage is over. Why do you need life insurance right now?
Precisely.
Because you don't have dependents on you. Your spouse is a dependent. So, your spouse is a dependent. So have a dual life pension plan. If you've got a pension plan, have a dual life pension plan. Your corpus is available to you. So clearly, just be careful. My biggest advice to senior citizens is please be very careful. There are people out there who can cheat you. It's very simple.
Right. What about term insurance plans? Now, a lot of term insurance plans now extend up to 75. That's many years after your retirement. People retire at 60, 65. Do they make sense continuing?
No. See, risk-based insurance planning is not meant to make money. So you never buy term insurance because you want to earn money. You buy term insurance to cover a risk, which is the loss of income that can happen. Of course, if you are working all the way, like my dad's 78, he's still working. So it won't make sense for him, but he has earned enough for the family in the last 20 years post-retirement through his own efforts that it would have made sense for someone like that to have a life insurance cover for these 20 years. But for a majority of people who have retired, and we're talking about retired, I'm saying their own effort is not leading to further income, then there's nothing to be protected from an economic standpoint.
So what's a decreasing term plan?
Okay. So a decreasing term plan...
So should they look at that?
They can look at that, specifically if they have liabilities. So the only reason they should take on a term plan or something of that sort is if they have a home loan which needs to be repaid. And to make sure that liability gets covered and does not get offloaded onto their inheritors, actually, a Puritan person like me would say, why even bother? People have to earn their own living, so why even bother about inheritance? But I think that practically that's not the right suggestion in India. You do need to think about inheritance. So rather than that getting loaded onto your inheritors, if you have a loan on your property, then having a cover for that is important. Although I don't think people give you loans if you're above 60 anyway. So that's the other aspect of it. So my take is life insurance is largely a no-no above 60. It's that simple.
So let's start talking a little bit about health insurance, because now that's an important subject, and that can also be a reason for a lot of your finances to be, I don't want to say squandered, but you end up wasting. If you fall sick, you don't have a good health insurance, you can squander your savings.
There was recently I was at a conference where there was a senior member of parliament who was speaking, and they said there is a possibility that a lot of people spend 80% of their wealth in the last 40 days of their life. And that is not very far from truth, because it can be very, very expensive if you don't have health insurance to go through a serious illness, which eventually leads to a terminal result. I think making sure that, pension and health are the two areas that one needs to really work on. So sweating the asset and making sure that it has the highest return, we've already spoken about. Health insurance is the most critical aspect. It is rather unfortunate if one has become 60 and does not have a health plan yet. If they are fit, as in they can go through the medicals, the first thing they should do is get that health cover. If feasible, get a critical illness cover.
So post 60, it gets very difficult to get a cover?
It's not about age per se, because today you have plans that have lifeline. You can enter throughout your life. So even Religare, Apollo, Max, these plans you can enter for life. Oriental Insurance you can enter for life. New India you can enter up to your 80. So there are lots of plans that allow you entry all the way. But at what cost is that entry happening? And under what conditions is that entry happening? How many, given our statistics around disease, how many people above 60 have no chronic disease whatsoever? So no blood pressure, no sugar, no diabetes, nothing, absolutely fit. Then you will get the health cover. But if even one of them has hit and you're above 60, extremely difficult. Because see, the insurance company is
difficult and expensive.
Difficult and expensive. The insurance company is not there to give money against a certainty. They are here to take on a risk. If they know a disease has happened, then they know that every year that cost is coming. And they would rather shy away. It's because they will lose money. It's not, they don't want to just take business and kind of have very high claims on it. They want to have claims. So 60, 70, 80% claims is okay.
So Yashish, we'll continue this discussion, but we have to take a short break right now. But do write to us any queries that you have, any questions that you have on queries@policybazaar.com. And we senior citizen investments in insurance, in healthcare, and of course, health is one of the critical factors, critical issues that they need to really look at, health plans, that is.
Yes.
Now, can you go over some of the health plans that are available for senior citizens in the market, Yashish?
Sure. So for senior citizens, you've got Star Health, which has got no medical entry. You will have a copay of between 20% to 40%. So in senior citizen plans, entry is easy, but there is an element of copay, and you've got to be careful about that. There is one from Bajaj. There is one from Oriental. There's one from New India. The Oriental one is called Hope. I think, of course, Religare, Apollo, Max all allow entry throughout life. Again, there are conditions to them. They may not even allow entry when you're 45 if there is a particular disease, etc. Right? So one needs to look at senior citizen plans from that perspective, that if you have to get into it as early as possible. So you have to get into a health insurance plan, have it as early as possible, and try to avoid the copay if you can. But if you're not getting a plan without copay, do not delay. Just take the plan with the copay and get into the plan right away. If you can get critical illness, please do take it. It may not be available for much longer. I think costs can come in very heavy from critical. In terms of coverage, try to take a big enough cover try to enhance the cover through top-up. So there's one particular trick which I can share. Suppose you were not getting a 5 lakh cover or a 7 lakh cover because your medical condition is such. So you could take a 3 lakh cover and take a top-up. Top-ups usually have more relaxed guidelines as far as underwriting is concerned. Because in a top-up, the top-up provider does not face the daily cost or the regular cost of low-end medication. They would only face the high-risk cost. So what you could do is take a 3 lakh rupee cover, which you could get quite easily, and then take a 7 lakh rupee top-up and essentially make it a 10 lakh rupee cover, and maybe have some critical illness on top of it, etc. But please get it as early as possible, because later on it will become difficult. The other advice I would give is, do not try to club policies once you are elderly. Once you are beyond 60, try to go for an individual plan. Do not go for a group plan, because otherwise you'll be grouping yourselves with other individuals who may not be in the same stage of life as you, may not have the same disease profile, etc. as you, and you would unnecessarily increase their premium. So clearly try to go for an individual profile and individual policy, so that sustains you through the rest of your life.
Right. And what about for couples who are above the age of 65 in terms of individual plans or floater plans? What should they opt for?
Individual plans. I would always suggest individual plans. See, life is such, somebody is likely to contract a disease. Now, if there are two people who are clubbed together, if one person contracts a disease, there's a chance that both of their policies would start to suffer in terms of lack of claims benefit, no claims benefit, some claims loading, etc., etc. If these are separate, then only one would suffer, and the other one would be free from that. Also they could have different kinds of diseases, and they might need to go separate ways in terms of what further policies, what add-ons they purchase, etc. So I would strongly suggest health insurance is a serious enough matter for you to take an individual policy and think about your own coverage all the way. If you're 45 and 20 years away from retirement, please take the plan now. If you've reached retirement and don't have the plan, please take it. If you have a company cover, definitely take a super top-up, because a super top-up will allow you to have the additional cover right now at a very low cost, and on retirement, suddenly get the full cover. Remember, health insurance plans are slightly easy to get into. Companies, the moment you have a pre-existing disease, the companies will start getting a bit tough after the third, fourth year, because that's when the exclusions go away. Just have to live through the plan. That's the advice I would give.
What about endowments and educational policies that they might want to buy for their grandkids, for senior citizens?
I think those are excellent policies. Both. So the one reason why you might buy life insurance policies is for the purpose of endowment, inheritance, or for the purpose of creating a long time annuity stream. There are plans out there, single premium plans, which basically take your entire corpus and convert it into an annuity. So every month or every year, you keep getting a certain amount. That can have a dual life benefit. So after one person is gone, it goes to the second person. After the second person is gone, it goes on to the next person, or it pays out the corpus at some stage. Those plans are great. So I'm all for those, as long as the person buying them understands the primary reason they are buying them is not returns, but is the endowment element of those plans. That these plans can create, so there are plans out there that gives you 6.5%. It's not giving the 8% that FD can give, but FD can only last 10 years.
Precisely.
After that, these plans can give you 6.5%, but they can give it on a continuous basis, and they can transfer from one life to the other. And those kind of endowment plans are very powerful. LIC has one. I think it was called Jeevan Akshay. I think it's a very good plan, and I think people can go for that.
Thanks, Ashish. Now it's time to take questions from our viewers. We've got Amit from Delhi. Now he has two active two-wheeler insurance policies for one bike. While he renewed his policy online, his father bought another policy through an agent. Now he wants to know how he can cancel one policy. Can he claim a refund against the policy that he chooses to cancel? So
a policy can be cancelled anytime. A general insurance policy can be cancelled anytime. If you're in the middle of the policy, you can just say, I've got a second policy. They might ask you for proof of the second policy, which you just provide, and you can cancel it, yes. So if you've kind of had the policy for 3 months, you'll have to pay for that 3-month coverage or something, but after that, it's kind of, you don't need to pay for it.
So that's simple enough.
Simple enough.
Yeah. And we've got Deepak Sahai, in 66. He would like you to recommend a travel insurance policy. He'll be traveling to South America for close to 59 days. He would like to opt for a plan that provisions for missed flights, cancellations, etc.
See, it's a very specific question. You'll need to go and kind of do a search on the various plans available. if you are traveling to America or South Africa, kindly take a coverage which is significant. So the minimum coverage is usually $50,000, about 30 lakh rupees. But as you go to a different country, these currencies can become kind of somewhat meaningless. I would say go for a $100,000 or a $200,000 coverage. The primary purpose of a travel insurance is actually health insurance. The primary purpose is not coverage for flight loss or anything of that sort. Those are very additional purposes, and those do not account for more than 10-15% of the total cost of a travel insurance policy. So just clarifying, a travel insurance policy is essentially a health insurance policy. So when you're traveling abroad, in case something happens to your health or to that individual's health who's traveling, then that coverage,
because that's where the major costs will come.
That is where the major costs will come. If you miss a flight, that is okay, $500, $1,000. For that, you don't need a $2 lakh coverage. So a loss of passport might be $500. So those are costs that you will be able to bear. Of course, almost every plan will provide you these. So, flights, baggage, passport loss, all those things they will. But these are quite frivolous covers. I'm not saying frivolous in the, like they are sensible covers, but they are more visible to you. The biggest coverage is actually the health insurance coverage, because if you fall sick there, which we can fall sick here, we can fall sick there, right? Then the travel insurance kicks in.
Right, Yashish, we've got Samir, he's 24 years old, and he says he'd like to buy a health cover for his mother who's 50, she's diabetic. However, her sugar levels are under control and she doesn't have any medications, but she has a bit of a BP there.
I think she should be able to get decent coverages. There should be at least 5-6 options available for her. If she goes in HDFC, Cigna, Religare, Max Life, Reliance General, I think Apollo, all of these can provide her a coverage. She's just got to go in and kind of check. L&T insurance. I think that there's quite a few options that she will have. Bajaj Allianz will have a good plan for her. Star Health will, of course, have a good plan for her. So there are lots of options out there. She just needs to go and check. There are about 15, 16 options out there.
Right. We've got Makhanlal Javer, and he'd like to know if he can claim tax exemptions under Section 80C against life insurance premium for his grandchild, who is, of course, a minor.
Yeah, of course you can. So, see, you cannot have the covered person. When you're buying the policy, you have to be the proposer. If you're the proposer, you will get the tax break. It's that simple. Up to 1.5 lakh rupees.
Thanks, Yashish. That's all the time that we have on this show. But last week we asked you a question. What is the regulatory body of insurance in India called? A, GIC, B, IRDAI, or C?